Everyone in the silver space loves one word: squeeze. Every time price moves up fast, I see the same comments. This is it. The silver squeeze has started. COMEX is finished. Bank shorts are dead. Then a few days later, price pulls back. People get liquidated, and the same accounts disappear until the next spike. So let's do something different today. Instead of chanting "squeeze" every time we see a green candle, I want to walk through what a real silver squeeze would actually look like. What data would move, in what order, and how you'd know the difference between a genuine structural event and just another volatile rally. Welcome back to Data Over Hype. Thanks for being here. Before we get into it, especially if you're new here, I need to repeat this clearly. I don't sell courses. I don't sell mentorships. I don't run a private group. I don't sell trading signals. If anyone uses my name or this channel's name to offer you anything, block them. I'm only here on this channel and on the official links in the description. That's it. I'm not here to sell you hype, fear, or greed. I'm here to walk through how this market actually works so you can think for yourself and make your own decisions. Now, let's talk about squeezes. First, what is a squeeze in plain English? A squeeze happens when people who are short, people who have sold something they don't own yet, are forced to buy it back at higher and higher prices because they can't get the asset easily, or their risk limits and margin calls force them to close. There are two key ingredients. Number 1, high short exposure. A meaningful chunk of the market is short. They owe metal, they owe shares, they owe contracts. Number 2, difficulty finding supply. It's hard to borrow, hard to source, or expensive to roll positions. So when shorts want to close, the only way out is to pay up. Without both ingredients, you don't get a true squeeze. You just get a strong rally where some shorts lose and some longs win. In stocks, we saw a clear example with GameStop and other meme names. You had extremely high short interest relative to the float, and suddenly a determined group of buyers piled in, pushing price up. Borrow fees exploded, liquidity dried up, and shorts were forced to cover at absurd levels. That's a squeeze. Silver is more complex. The shorts are not all sitting in one neat pile of stock. They're spread across futures and options on COMEX and other exchanges, forwards and swaps in the OTC market, unallocated and synthetic products, hedging structures for miners and refiners. At the same time, the physical market is global, with different regional prices, inventories, and logistics constraints. So when someone says the silver squeeze is on, the first question to ask is, where exactly? Which shorts are under pressure, and which supply is truly constrained? Let's walk through what a real, system-wide squeeze would probably look like, step by step. Not the memes, the mechanics. The first sign would not be price on its own. Silver can jump 10, 15, 20% in a short time just from normal volatility, fund flows, and margin dynamics. We've already seen that multiple times. The first real sign would be the cost of borrowing silver and dollars against silver starting to spike. In technical terms, that shows up in things like lease rates and forward spreads. When metals are easy to borrow, lease rates are low or even negative. When metals are suddenly scarce, lease rates go positive and climb quickly. You also see stress in the difference between spot and futures prices. If people are desperate to get physical now rather than later, you can get backwardation. Spot trading above futures in a sustained way, not just a tiny blip. So in a genuine squeeze, you'd expect to see persistent backwardation in key contracts, lease rates for silver moving sharply higher, the cost of rolling short positions forward becoming painful. At the same time, you would see deliverable inventories at major hubs being drawn down rapidly. On COMEX, people often argue endlessly about registered versus eligible stocks. I'm not going to relitigate that debate here, but in a real squeeze, you'd want to see deliverable inventories consistently trending down, not just on one exchange, but across multiple vault systems. Large, credible players taking delivery and not immediately releasing metal back into circulation. Refiners and mints publicly saying they're struggling to get feedstock, not just running full capacity on retail products. If registered stocks dip, but at the same time you see huge inflows into ETFs or other inventories, that's just metal shuffling. A real squeeze is about net availability, not about shifting bars from one pocket to another. Third, you'd see behavior change in the futures curve and in options. In a normal, strong rally, futures prices might run ahead of spot because people are speculating on higher levels a few months out. In a squeeze, the opposite often happens. Shorts who owe near-term delivery bid up the near contracts. The curve can flatten or invert as the pressure focuses on the front of the market. Options would show it too. Implied volatility would spike, especially on near-dated calls. Skew, the relative price of upside calls versus downside puts, would lean heavily toward the upside. In plain English, people would be willing to pay a lot more for the right to buy silver at higher prices soon, and shorts would be paying up to cap their risk. Fourth, and very importantly, you would see forced behavior from specific types of shorts, not just chatter on social media. For example, hedged miners may reduce or close forward sales because the cost of rolling hedges is too high. Commercial participants who routinely short futures against physical stocks might say, "We're not comfortable with this structure, we're scaling back." Banks with large short books might be clearly reducing exposure in the data, not just theoretically. You'd see that show up in positioning reports. Commercials covering aggressively into the move while other categories scramble. And finally, you'd see the physical premium story go from tight and hot to borderline dysfunctional. We've already seen episodes where premiums on coins and small bars jumped, dealers rationed inventory, and some products went on backorder. That can happen simply when retail demand spikes and mint capacity is finite. It doesn't mean the entire global silver system is broken. In a real squeeze, those premium spikes would spread beyond retail into wholesale, show up across multiple regions, not just one or two, persist even as paper prices move higher because the bottleneck is physical availability, not just short-term retail demand. Big industrial users, think solar manufacturers, electronics producers, big fabricators, would start talking about substituting materials, changing designs, or facing delays because of silver costs and availability. That's the kind of footprint a genuine squeeze leaves. Now, compare that list with what actually happens most of the time when people shout, "Squeeze." Silver runs up fast. Retail demand jumps. Dealers have a hectic week. Premiums on coins widen. Social media explodes. Maybe COMEX inventories tick down a bit. Then price retraces. The leveraged players get shaken out, and everyone pretends the failed squeeze was really just phase one. That is not a structural squeeze. That's a strong, speculative rally with a tight retail market layered on top. So what's the point of walking through all this? It's not to say a real silver squeeze can never happen. Under the right combination of macro shocks, policy mistakes, mishedged players, and sustained physical tightness, it absolutely could. The point is that overusing the squeeze narrative is dangerous for you as a trader or investor. If you believe every spike is the start of the final squeeze, you're more likely to chase bad entries at stretched levels, use too much leverage on the assumption that dips can't happen, refuse to take profit or manage risk because this is it, I can't miss it. Hold on to losing positions long after the structure has changed, telling yourself that pain is just proof you're early. Meanwhile, the players on the other side of your trade, commercial desks, funds, market makers, are not operating on slogans. They're looking at the actual data, lease rates, inventory flows, curve structure, options pricing, and counterparty risk. When those metrics say pressure is easing, they act accordingly, even if social media is still screaming, COMEX is dead. So how should you use the concept of a squeeze in a way that actually helps you? First, treat squeeze as a hypothesis, not a religion. Ask, do I see evidence across multiple parts of the market, futures, physical, options, curves, that shorts are genuinely under structural pressure? Or am I just projecting what I want to happen? Second, size your positions so that you don't need a squeeze to survive. If the only way your trade works is if we get a once-in-a-decade event, your size is probably too large. A good position can still make sense in a strong but normal bull market without a textbook squeeze. Third, remember that you are not required to catch 100% of any move. A lot of people destroy themselves trying to be heroes. If silver moves higher over years because of macro, you don't need to ride the single most vertical portion from the absolute bottom tick to the absolute top tick to benefit. You just need to participate intelligently without getting blown out. And I need to say this clearly, like always, nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I don't know your situation, your responsibilities, or your risk tolerance. I'm here to map out the mechanics so you're not basing your decisions purely on slogans and emotion. If you've watched this far, I want to hear from you. When you hear the phrase silver squeeze, what do you think of now? A real structural event, or mostly a marketing term people use to hype any big move? Have you ever chased a squeeze and regretted it? Drop a comment and start it with either real squeeze or just a rally, so I know which camp you lean toward, and tell me why. You might see something I haven't mentioned here. If this kind of breakdown helps you cut through the noise, looking at actual signals instead of just big words, consider subscribing to Data Over Hype and turning on notifications. We're going to keep talking about silver, gold, and the macro backdrop in a way that respects both the upside and the risks. Use your own brain. Stay within your limits. Don't follow anyone blindly, including me. Thanks for watching. Take care of yourself, and I'll see you in the next video.